Hey everyone, it's Ed Kime from over at Quantcha, and welcome back to another week of the Quantcha Challenge. As always, we invite you to check out our unlimited commission-free stock and option trading offer for just $99 a month, where you get commission-free trading plus everything we offer in our web tools. And we're going to be working with that once again today to manage a portfolio that we have in place. So I'm going to come from our dashboard, click through to check out the portfolio. Now we have an up day in the market. Pretty broadly across the board, everything's up. We are bullish on Carnival still, so this is moving in our direction, which is nice. For Microsoft, we're bullish, but we do have this 106 call expiring today, and the stock's been close or over 107 pretty much all day. Just as a recap, we opened this up a while back as a covered call. We're going to continue to be bullish on Microsoft, but because earnings is next week, we are going to close this position out today and then open it up after earnings has been cleared up. Potentially, we might come and add a secured put going into next week just because we wouldn't mind buying it at a discount. Because even from here, like I said, I'm pretty bullish. But on the other side of the coin, we've got Micron, which we were bearish on, opened up. This immediately bit us and is still pretty far out. It's still 3 weeks out, but at this point, the liquidity and everything else in play, the best we could hope for is to take a total loss right now. So there's really no motivation at this point to close this trade out. It takes up a little bit of margin, but we'll just let it ride and see if maybe we can't get something out of it. Still not bullish on Micron, although I wouldn't open this trade today, obviously, seeing as how it seems to go up quite a bit every day. And then Exxon, we're still bearish on Exxon. It's on a day when the market's up pretty well, everything seems to be having a good day. They're moving up. That's going to happen. We want to keep them below 72 if we can as we approach next week's expiration. But for the time being, we're still tiny bit up on the trade, plus with liquidity. So a few bucks, not too bad. It is giving us at this point some nice negative delta that we need towards the portfolio. That number is going to help us because we were bullish on Microsoft, but it recovered nicely. So from earlier lows in the week. So at this point, the only short-term immediate trade that we want to focus on is this Microsoft covered call. And what we're going to do is we are going to close it out. And we may come back and decide to open a secured put later on. But at this point, we're looking to sell 100 of it. We're looking to buy to close the call we're short. We could do these as separate transactions, but I figure why not just see if we can get a little bit more than what's being offered. Right now, because we're so deep in the money on this call, it's going to be a bit further out. So I think what we'll do is we'll actually go ahead and I'm going to try to close the option. I think we'll just try to close it separately because it would be the stock's going to be easy to unload, and I don't want to kind of offset too much between the two of them. But the risk that we have right now is if we try to close the position out together, we're going to get worse pricing. But actually, I take it back. That was a mistake. In general, you want to close out all your positions at the same time if they are tied to each other. So we'll just see what we can do here and see if we can get, at this point, I think it's 10, would it be 108 for the credit? That can't be right. Yeah, that's a little odd. So if it's 107 and it's going to cost us money to close it, yeah, there appears to be a bug that we have here. We'll have to take a look at that and figure out why the net pricing is coming back at that point. There's no way this 108 is going to fill for us. Just trying to think if I'm missing something here. We should be expecting to close this trade out. Yeah, there we go. There was some kind of pricing or mess up there. This is a little closer. We'll just put this at 106 for now and let that sit there while we look at some other stuff. See if with the jostling of the volatility and everything else, we can get a fill on that. Now, stepping back, we're getting into earnings season, and we did a couple of earnings trades so far. We did for Johnson & Johnson a couple, I guess it was last week, we did a nice straddle trade, pre-earning straddle trade, where we closed it out for a very tiny profit. And then this week we had a really nice trade where we did a calendar straddle against Granger that turned out to more than double the investment, which was really good. let's go into the screener and let's kind of set things up. Now, I think we're going to be looking at these trades quite a bit, and the screener is a really good way to zero in on them. So what we'll do is we'll set up some basic parameters for the kind of trades we're looking for, and then we'll save it. This way we don't have to do this every time. For now, the first thing we'll look at is I like to look 5 to 6 days out. So this basically means 5 trading days. That'll include today because the market's still open, meaning that like if it's today that we have this, then 5 trading days until earnings means that it's through next Thursday. Since next week, Monday, Tuesday, Wednesday, Thursday, this means that the earnings will either be after hours on Thursday or before on market opens on Friday. So at this point, we're looking at a trade we can open up today that we will then close, and because it's 5 to 6 trading days. So basically, something we can close either Thursday or Friday of next week, which would be the day before earnings. So we're going to look to do a pre-earnings straddle trade. And the idea for that is that we know that we expect implied volatility for the options at the money to rise going into earnings. So what this gives us is the ability to open up a position that's a call and a put at the money, and then if the underlying moves significantly between now and their earnings, we can close that position out for a profit. But if it doesn't, and we need to close it out the day before earnings or the day of earnings or whenever it is before the earnings announcement happens, we can exit the trade and try to retain most of the value because the implied volatility rise between now and then will cover the time value. That's kind of a roundabout way of saying that we're going to pay a certain amount of time value now, and we expect that most of that time value will still be there when we go to exit the position. Ordinarily, that wouldn't be the case because you'd see a pretty consistent decline on theta. You'd see your theta burn and just your long options would lose value day by day. But we find that leading into earnings, this doesn't always happen. So trading days 5 to 6. For this, we do want to trade stocks that only have great liquidity. We might lower this down to maybe we'll lower this down to good liquidity so we can get some stocks, some more to choose from. And we want to make sure they have weekly options because we're going to go for, we want to trade like that week's options. And this should generally be the case within stocks that have good liquidity. They'll almost always have weekly options. So that's just sort of a basic thing there. The last thing we're going to do is we're going to sort it by the earnings crush rate, and we're going to sort it by the decreasing earnings crush rate. So we want to see the highest ones at the top. Now, what we're going to do here is I'm going to save this. We're going to say pre-earnings straddle. And this way, whatever we do, we can now go, if we reset our settings and we get back to our defaults, simply enough, we can just jump back in. We've got our pre-earnings straddle. Now, the sorting here, we want to sort declining by crush rate. Now, the reason for that is the crush rate tells us what the options at the money for the expiration immediately after earnings is currently trading at. So, let me back up a second. Let's say the volatility of the week immediately following earnings, or the expiration immediately following earnings, is at 100% volatility. The 95.61% crush rate says that our analysis of the options around the money and the expirations around the money indicate that the market is pricing those 100% volatility options to decline to 95.61 after the earnings uncertainty is cleared up. Now, it's a pretty complex process to extract that, but effectively what we do is we take options over the long run, and we are able to go in and say that based on the pricing of those options and the options in the weeks following, that if you were going to price a break-even trade at this point, you would do so with the expectation that the volatility will be this percent of its current volatility after the earnings is cleared up. Now, when this number is high, like when it's close to 1 or above 1, that indicates that the options immediately after earnings are not really expected to change from their current volatility. That means that that's kind of where they're expected to be trading based on current market pricing after earnings. So in this case, because these guys they announce in like 5 days, this tells us that there really hasn't been a run-up on the options at this point for those. Whereas in this case, for Amazon, they're expected to lose a third of the volatility for those options. So if we take a look at Amazon, we can see, I'll give it a second to do the latest numbers, we could see that the immediate post-earnings options are at 53%. That's pretty high for Amazon. It's not as high as it will get leading into it, but it is pretty high. But it indicates that after that, the expectation is that it should be trading around, in this case, 2/3 of that. So we'll just say, I'm always bad at doing math live, but what is it, around 36% or so, which is around the long term, movement here. So the that volatility information is helpful because if we use the back button to go back and take a look at where Exxon is, the Exxon volatility, this is already pretty high. I'm sorry, this is not pretty high. This is relatively low, but the expectation is that this will go up much higher. So this 27% versus the 20% long term, the immediate after earnings drop is going to be in this range. So what we want to do is we're going to take this trade, and so for February 1st, these are the February 1st options. I believe they announce before market opens. Yeah, that's important because obviously if they announce after market, then the options expiring that day, you wouldn't be able to trade them by the time you have the news, so they wouldn't be particularly valuable. So what we're going to do here is we're going to take these this trade here. We're going to go right to the option chain for it, and we're going to take a look at the money. In this case, they're trading around 71.67, so we'll say the 25s. And we're going to do a long straddle, where we're going to buy a call and buy a put. We'll see that the investment's about that much, so if we change this to 500, I would assume it'll just double that, since we don't have any commissions or other fees to worry about. Now, you'll notice we get the earnings review. It's before the earnings announcement is before expiration, which is fine because we're going to sell them on the 31st of January. The liquidity is good. The pricing model, in this case, it's about a 50% model, but we don't really care too much about the model or the probable return for this trade holding through. What we're hoping for is any kind of movement we can see beforehand that'll get us some profit, so that we can close it out. Now, another interesting thing here is if I take this and model it in the book, we already have a bearish position on Exxon. So this will just add it in, and now we can see for that February 1st expiration, the blue line is what the expiration is for our current position. Now, we did, when we opened up this bearish trade, this bearish call spread, we opened it up with the expectation that we wanted to be out of it before earnings. So these trades are a little bit, they're aligned, but the interesting thing is when we opened it up for earnings, I believe at the time the information we had was the expectation was that these would not be in expiry, would not have that earnings impact. Unfortunately, it looks like maybe the numbers jostled a little bit. We opened it up a couple weeks ago, so it's probable they just pulled it in a week when they finally announced. So we do have that little bit of a thing to be concerned about. But the point is, we're probably going to close this out before earnings as well, and this guy we're going to trade beforehand. So taking a look at the chart now, we can see that the blue line, that is our current holding and what the price payoff will be if we just had our position. And this here gives us an idea of what expectations to have for the current straddle trade that we added to the book. So this is all 4 positions, and this is just the 2 positions that we currently hold. Now, in this case, we are going to open this trade because this is it is very much a trade. It's an expectation we're going to see volatility rise between now and then. This is not a trade that we'll probably look to get a ton of money off of. I think maybe what we'll do is after we open this up, let's see here, it's at 231, so we'll just try to nudge it down a little bit, preview the order, see if we can edge out just a tiny bit of edge on our end. We'll check back in at and we're going to let this sit for a bit. We'll check back in on the Microsoft order, 105.97. We'll go to mid, see if we can fill. At this point, we just want to close this. It's not really a big deal what we get for it. We just want to be out of it. We know we're going to end up with some profit on the trade. I'll take a second for that. Oh, that filled out. Nice. And while we let the Exxon thing hang, let's go take a look at Microsoft. We're going to take a look at portfolio performance. And we will go to only Microsoft. And we will zero in on what we've done in the current quarter. So this is just the trades that we've done this year. And as we can see, if we come to the specific trade, we've got the covered call that we just exited. We opened it up on the 9th. We paid a little over $10,000 for the stock. We sold that 105 against it. The next week, we rolled our 105 out to 106, collected a little bit of credit, which was nice. We also gave ourselves that extra dollar of breathing room because the stock was appreciating. And then finally today, on the 25th, we were able to sell out. We bought, I'm sorry, we sold off the stock, we bought back our call, and we ended where we are. So the net is from the 9th to the 25th, that's 16 days, we were able to make about $350 on trading Microsoft. So that worked out pretty well. Like I said, after earnings settles, we'll probably come back in and try to do that again. There's usually some pretty good premium for the tech companies just on a typical week-to-week basis. And again, we're not trading too aggressively here. We're trying to be pretty conservative with the options trading and show that we can make a gradual gain over the long run, weather some good and bad market behavior. But that being that, let's check back in over at the orders to see how we're doing for Exxon. We didn't quite fill what we were asking for. We're at 230. Now that is the midpoint at 230. We'll let this hang for now. We had that screener. We have our pre-earning straddle screener. But the other thing we might do is instead of the pre-earning straddle, there's also the trade of the pretty much the overnight calendar straddle that we were looking at. And so all I have to do is if I just update that, it's going to keep the settings we had from before. So we have at least good and weekly options. We can see Caterpillar is the only stock that fits for that. I do want to save this because this will be our Ivy Crush calendar straddle, we'll call it. And you notice that we are working largely in the stock screener. If we wanted to, we could take, for example, this stock and we could look at and say we want to see long straddles and then jump forward to the trades that are available and use the stock screener. And at this point, what it is that it imports everything we had set up there, but now we can zero in on these guys. Like we can say we want at least 100 open interest and we want this only to be a trade that expires only after expiration, and it'll give us those trades if they in fact exist. In this case, we've got stuff that fits in here. But going back to the screener we were just at, the Ivy Crush calendar straddle, we've got Caterpillar here, and we see this 63%. In my experience, that is not a that's not a great crush for an opportunity. We could go and model that if we wanted to and try to figure out if there's trade potential there. So we'll select Caterpillar. We'll take a look at now again, be careful because we're doing this because the earnings is on Monday. There is a Friday that's before earnings. We don't care about these options. They're not going to help us play the crush. Now if we see the crush is currently at 47%, 39% is the after. Again, that's indicative, like the earnings richness, and this is a great thing to point out here. The long-term volatility mean right now is 31%. So the earnings richness is actually negative, which means that if we were going to trade this, we might actually have a better shot at trading the volatility for Caterpillar by going long a calendar here, possibly hedging it with a short calendar here for pricing, just to offset the cost, and then the crush might impact both of them evenly or close to even, in which case we would have the opportunity to profit more on basically selling these and hedging it with these. We're not going to do that. That's just, I don't think that risk is right, given that we don't know the stock super well, and I don't really follow the volatility movement here. But there's various ways to construct trades, and you can check out some of the other videos we've done to talk about calendar straddles and setting those up. I wanted to step back though and take a look at where we are with the portfolio right now. The Exxon trade not yet full. The other one I was looking at was Nvidia. Now Nvidia was the stock we talked about quite a bit about a week ago, or maybe it was even earlier this week. I really liked them in the long run. They were under 150 at the time. They're already at 160. Now, I was looking at potentially taking a long-term, or not a long-term, but like a 6-month trade, buying a call here and then financing it with calls sold leading up to it. The problem was that this volatility right now, this 45%, is really high, and I don't know that we can expect it to stay there after the earnings call. But it's, I guess from a historical perspective, it's really not too bad. The earnings we can see that the earnings richest right now, it's not too expensive for the options at earnings. So what we might do, sorry, what we might do is maybe we'll buy a call here, and I'll just go for something a little out of the money, like at 160. I'm sorry, we're at 160. If we went to 170, and we'll take a long call, we'll just look for one trade. I'm going to add that to a book, and then we'll come back. We'll go back to where we were, and I think let me take a look at the volatility here for Nvidia. So the term chart shows that we've got about in the 40s leading up to the earnings announcement itself. So that's indicative that this is probably about the right level of volatility that this stock's going to trade at. So I think that what we might do is, since we're holding this call, if we hold that call and we sold next Friday's, I'm just curious to see what we would get if we went to, it's actually easier to do this in the book. So if we go back to managing our book, now we are looking at buying the 170 call. Let's say we went to the February, which is just next week. We looked at the calls and we went to 170 again. If we trade at 170, we can get $1.40 at this point, which is not. It's actually not bad at all. Now, if we made the action to sell that, what we'd be looking at here is we'd be long the 170 in June, short the 170 here. We'd get about 10% credit back on opening up that long call position. Now that's good. I mean, especially if you can keep rolling the trades to give us a typical calendar chart. But the downside is, at that point, if we were to have the appreciation of the value of the underlying through then, we'd be looking at probably hitting this range. It's pretty unlikely it's going to be above 185 between now and then, where we would start to lose money. So this would be a pretty good trade if we're bullish on it. But the downside here, as you can see, is really substantial. I mean, they were this low. If we go back to the 3-month chart, they were down to below 130. 124 was the lowest they actually hit. And we could see that's so far down here, we would lose virtually all the value. We'd have a little bit of long distance YOLO time value left in our long call. But this trade, especially leading into earnings for me, is it's a little bit too risky. But I still, again, kind of kicking myself a little bit, because when we were at 147 last week or earlier this week, this was a trade that would have been great to put on. We could see a lot of value. Although, in fairness, and I should point this out, at the time when we were looking to place that trade, we were looking at the money, at buying an at the money call and then selling an at the money or slightly out of the money call to finance it for this week or next week, which meant that this 160 would mean that we would have to realize a big loss on that call we sold short, only to get a smaller gain on the call we were long. So in other words, if you look at it in terms of this chart, we were here at the time when we were looking at making that trade earlier, and right now the stock is about here. So we would not have made the kind of gain we were looking for. But let's go ahead and we're going to step back for a second here and do a little portfolio management. We got our Exxon fill at 230, which is nice. So if we come back and we take a look at it now, we have really 4 positions, but kind of 3. I mean, we've got Carnival bullish, Micron bearish, and Exxon we are bearish on, but we also have a short-term straddle that we're holding. You can see that because Microsoft's out of the way now, we're holding a ton in cash. Now this cash number here also includes the cash we hold. This doesn't include, rather, the cash we're holding towards margin. So that margin is held up in these numbers here. So for example, the Micron trade is holding $900 as margin, because it's including like the 450 or whatever we collected as a credit, plus the remainder that it would take to make the trade whole in the event it went completely against us. Same for Micron. Same for Carnival. And then for Micron, we've got 2 trades. We've got a bearish trade, but we also now own this straddle in the middle. So if we take a look at the book right now, the market seems to be hot. So we definitely don't want to leave ourselves with a negative beta weighted delta, because this is just telling us that as the market were to keep moving, it would hurt us. In this case, the biggest culprit right now, Carnival and Micron are kind of canceling each other out. This is comfortably in the money. This is they're both comfortably in the money as far as we're concerned. This is a full negative loss, or full uh, positive gain. And actually, let me back up for a second there. I know we had some questions about spreads. So this we have the spread here where we're short the 52. We're long the 52 and a half to cover a 55 put that we're short. So in the event that we can get to expiration with this closed above 55, as it's comfortably above 55 now, if we get it at expiration, both of these will expire worthless. So as time goes on, the value in these options is going to continue to go down. When our long goes down, we start to see a loss on that option. When our short goes down, we see a gain on the option. Now, what we want to see is that this goes above 55 as far as it can, so that by the time we get to expiration, we just let them expire. And then, of course, in talking about that, on the Greek side, this theta, this is going to be positive for us. You can tell a lot about somebody's positions just based on the Greeks they're holding. So, as an example, the delta we have here being positive for the book means that we want it to go up. We have a lot to gain if the underlying goes up. The gamma means that as the underlying goes up, delta will start to decrease. In other words, it means that the amount of delta we get from it going up will decrease. Now, if we were just long a call, these would both be positive. But in this case, because it's a spread, there is a peak where we get diminishing returns on how much the delta can go up because there's only so much money left in the credit that we're looking to collect on. When you see a theta that's positive, that means that that trade benefits from the passage of time. And another thing that we're looking at is for this trade to pass over time. And because it's a credit trade, you're going to see vega that's negative. A negative vega means that your book would actually be hurt by an increase in the implied volatility, or in this case for a credit trade, it would benefit from a decrease in the implied volatility. And rho again is about interest rates. If we were to see the risk-free rate go up by 1%, we'd expect that $2.12 hike in the value. So we're trying to keep this number here closer to zero, although frankly I think right now we might go positive, because if we take a look at the S&P's movement over the past month, it's been moving up nicely. And in addition to that, the market has also been not the market, the White House looks like they just announced a improvement or a deal, some kind of budget deal, or at least short-term funding to get the government back to work. So this is going to be met positively by the market. As we can see, going back from here, we were a low of 238. Today we saw a high of 266, almost 267. So it would be a mistake for us right now to call a top. I think that one option we have is we can try to be market neutral, which is where that beta weighted delta number comes in, or we can actually add something bullish to be a little bit more to be a little bit more beneficial in the event that we saw a rise. There's a bunch of different ways to trade that. I think what we might do is we'll go to our dashboard, we'll take a look at opportunities, and we'll just take a look at the top gainers. So this is not the nicest chart, but we'll just take a look at some of these companies. Oh, actually, better yet, the screener is much better for this. So we'll go to our stock screener, we'll reset, and we will just say, based on today, show me the let's see equity change from top to bottom. So these are the optionable stocks, and we want to see how they've done today. And these are the ones that have gone up generally because of probably announcements or some kind of volatility. I think never mind this. We've got Nvidia. I think what we'll probably do at this point is let's put in a bullish trade for Nvidia for the leading up to the week prior to earnings. Not great to do that, but we'll say we're bullish. This is highly correlated with Micron. They're both very similar. When there's up days, they go up. We'll put on a fairly short-term trade just to get us some of that positive positive beta weighted delta, just to balance out the book a little bit more. And we can see here there's some good opportunities. If we took a look at the highest potential, we could go for this bear call spread. It's obviously pretty far spread out in how it is in the strikes. If we look at the daily movement, we could see it started low, kind of moved back up. There's no real guarantee that the stock is going to go up between now and its earnings date, but we're kind of looking at where the market is trading, and we're going to take a bit of a risk here. I'm going to come in. I'm also going to say, what if we traded for, let's say, a budget of 500? Actually, I'll go right to the trade itself. We're going to go for the one with the highest potential return. We'll scale it up to get to a budget of 500, and then that's just just the one actually. Actually, come to think of it, looking at this, we can't even place this trade because of the requirement there. So let's go back to our search results. Now I did set my budget at 500, so it's going to run through, model the trades, evaluate the performance, and do everything, and it'll just pick off the ones that we can't trade because they have an entry point north of 500. So this will take a second here. A lot of options to chew through. Updating all the data, and so here's a much more accessible trade for us. It's a little closer to where the current price is. And let's see what the best average is. Yeah, it provides the best average and the best potential for the amount of investment we're looking to make. So let's just go ahead. This trade is as we'd expect. It's likely to be profitable. If we wanted to give ourselves a little bit of room, what we could do is we could come back to this. There's a few ways to do this. Sometimes people like to make a trade where they're going to take a spread like the one we were looking at, and they're going to say, I don't want to trade something that has to go up to turn a profit or is in the position we were at. I'd like to trade something with a higher probability of profit. And the way you can do that is you can just move this down here. And you could take this and move it all the way up. And if we take, let's say we move down and we wanted to model a trade that had a 70 or 60, we'll go to 70% probability of profit. This is saying that this is the range that we're going to model against, and this could go up as far, for whatever. You could also tweak the number up here if you wanted, but we're going to say find me a trade that is profitable in this 70%, and we already have this option checked here. We've already set this to minimum return of 0. So now the trades that are returned will have at least a 70% probability of profit because we've modeled for the 70% range, and we've said don't show me trades that aren't profitable. So in this case, that should be, it's going to be a smaller set of trades because we're asking a lot more. But you can see here, we've got something here, and if we click through, it's only a 30% return, but we've got a 71% probability of profit. And it really goes down. You could get a drop of, in this case, if we modeled this, let's throw it at the book. If we model this trade at this point, we're gonna, we still have our positions from earlier, so let's whack the ones from the 8th. Oh, I did that wrong. We'll clear out the book. Got the dates wrong. We'll just go back to the position we were looking at, throw it at the book again. So now we're looking at just that spread, and we can see that we're going to be profitable if we can stay above 152. So if we don't see a drop, I'll be able to do that. Now, the downside to this trade, though, is because we have a higher probability of profit, there's a lot less return that we can get. It is a put spread, so hopefully the stock stays up and we see a return. But it also doesn't give us a ton of delta. It gives us a bit of delta. It would bring us closer to 0. But it also gives us a gamma, a positive gamma, which we would like at this point. Or actually, this doesn't really impact the gamma. But right now we're looking at a positive gamma. Which just tells us that if the market continues to move up, that we will see an improvement in our data, in our beta weighted delta. So we'll just go ahead and we'll trade this higher probability trade. And we'll ask for 70 cents. And we'll go ahead and we'll put that in there. So we're going to see if we can get 360 on it. Our margin change, we're going to have to hold 500 in margin, so we'll throw that out there, just doing a quick sanity check to make sure that the numbers match up where we want them to be. Good. And we'll submit the order. This will probably take a little bit to fill. I did want to go back to the NVIDIA book that we were looking at and point out one other thing. We were talking about the probability of profit, and a lot of times people will use the delta in order to determine your probability. What that basically means is that you'll see, like, when a delta is, and if we scale this down, we'll get the numbers that are, right now it's doing a full book. So if we make this 0 or 1 and -1, we can see that the delta for this is almost 22, and this one's 27.5, which means that for every dollar the underlying rises, this put should lose 22 cents in value. That's just the nature of how the Greeks work. Now, in trading that, if you were just going to trade this long, that delta means that a lot of times people will use it as a rough approximation to say, well, the probability of assignment is about, uh, so that 22% would mean that it's about 22% likely to be in the money at expiration. We do assignment that's a little more precise with the modeling. It's a little more complex, and we go directly to the underlying financial theory, the Black-Scholes in this case, because there's no dividends, and get you that 23%. But it's good, in a pinch, you can use these as a good general idea of this is a 27.5% likelihood of being assigned or in the money at expiration. We model it at 29%. But what you can generally see is a lot of times if you can see an edge of the delta you get versus the assignment probability, meaning that if your delta is above the assignment, then that means that you're going to probably see more. You can sort of figure out that I'm more likely to make a profit on it, or I have a slight edge in the trade based on delta relative to the assignment. But backing out of that, go back to the portfolio, and wanted to. There was one other thing we wanted to look at. So we've got this position we're in for our delta. We'll just go ahead and, you know what, we're just going to step out and try to close this trade to get it on the books, as long as we don't have to give up too much for it. We'll see if we'll hedge into 69. We'll just edge down step by step to see if we can get this guy closed. $66. Uh-oh, we might have to start chasing. I don't want to go too far down. So we'll let this relax for a second here. Oh, the one other thing I wanted to call in here is we have this this Exxon trade. Now, the goal of this trade is to eke out a profit from some movement. One of the things I'm going to do here is we're going to take the straddle we have, and we're going to put in a standing order to close it if we can get to a certain profit point. Now, this would be one of those things where you kind of think about where you are right now. Like in the trade we had, we opened it for $2.30. I believe that was the per share that we ended up closing at. So, and I can double check from orders. 230, yes. So in the event that we see significant movement in Exxon, we'd be pretty happy to sell it to take a profit on it. So I'm going to say close the book. Now that's going to bring in all the options that we're holding right now. I'm going to get rid of the options of our spread here, because we're not really worried about that. And so right now we would get 228 if we were to try to sell it off, or if we got it closed at midpoint. There's a certain point where we'd be happy with profit that might happen when we're away from the machine. And so what we'll do is we'll come in here and we'll grab, let's just say $3, right? I mean, would we be happy if we could sell this for $3 right now? And I think we would. So I'm going to put a good till canceled order. Now, this runs the risk of, in the event that we wake up in the morning and Exxon has gone up 25% or it's dropped 25%, we'll get kind of stuck at around $3, maybe a little better, but we won't quite make as much. But if this starts jostling around and moving up and down, and it just happens to trigger where somebody's willing to take it off our hands for $3, we want to give them the opportunity to do that. So let's just go ahead and place that order. And because it's good till canceled, it's going to just sit there. It's going to sit there and hang out until either we cancel it or somebody closes it. But we can always come back and change it if we want to. But for now, we'll just leave it out there so that if we do see some nice movement, we can capitalize on that without having to fret over whether we're seeing enough of the movement or any other things that you kind of worry about on a day-to-day basis. And we don't have to wait for this, because that order is just a long-term order. Let's come back here, chase NVIDIA a little bit. All right, we're going to try this 65. And if we can't close it at 65, I'm going to just I'll put it back at 70 and let it sit for the rest of the day. We don't need to keep streaming through that. We'll give it 5 seconds. 4, 3. Oh, there we go. Filled it. 66. So good. We're glad to have it on the book. So now we can kind of take a look at where we are going into the weekend. We're still negative on our beta-weighted delta. I don't love that, but at this point, I think we're going to sit there and just kind of accept it. That's where it is. And then on the prices, again, this Micron trade, basically a free trade. We've already accounted for all the loss. We're just hoping to make something up if it does find itself falling again. So that's where I'm going to leave it for the weekend. We close out of our Microsoft position. We were able to profit on that. Carnival's moving up for us nicely. Exxon. Now we've actually added in a bit of a hedge, so we'll get double the benefit if it drops. And in the event that it moves up, we will our long haul position as part of that straddle right here should be able to offset some of the profit. Yeah, that's where we leave it there. So if you have any questions, please leave a comment below or hit us up at hello@quantcha.com. And as always, good luck and good hunting.